Welcome to Option Trades Today. I'm Tony the Baptiste, and I've got a trade idea for you today. June 15th, 2023, and what a market we have. Let's take a look at it. E-mini S&Ps are up 30 handles right now, $30.25, making recent new highs. NASDAQ also up $78 after being significantly lower on the opening. NASDAQ up $78, another half a percentage point on top of some, historic moves. The relationship between NASDAQ Russell continues to be the same. Russell not participating, NASDAQ overperforming. Dow up 356. The Dow lifting its wings over the last couple of days, trying to steer itself away from the Russell and act more like the E-mini S&Ps or the NASDAQ. Now, one thing I see, which I have not seen for quite some time, is volatility up when the E-mini S&Ps, the NASDAQ, now you even have the Russell and the Dow up. A sign that maybe this up move is getting a little bit too frothy. Maybe. Obviously, nobody knows when it comes to direction. So I'm going to steer away from what I normally do, which is typically go into the high option volume, look for an IVX 5-day change that's expanded, look for no earnings coming in the following cycle that I'm going to be trading. And I'm going to go into an ETF today and look for a little bit of short delta in a Johnny way. And I'll explain to you why in a Johnny way when I show you the trade I'm going to do. So I'll look at SPY, and it's got an IV rank of 3. I'll go to IWM, and it has an IV rank of, let's just call it 3 also, maybe 2. And then I go into the Qs, and it's going to have the highest IV rank of them all, only at 8. But you can see the Qs here flirting with or about to make maybe new highs that we haven't seen in almost a year. Okay, so for me, that signals you got volatility up only 15 cents. Don't at me, I get it, it's not a lot. You got IV rank at 8. Don't at me, I get it, it's not high. But I'm going to look for some short delta in a Johnny way for that reason. I'm going to go to my July options like I normally do, the closest to 45 days. I don't like trading weekly options, although in the Qs, you could make an argument that the markets are pretty good and the volume is okay. You'll see the volume in a moment on the regular monthly options, and you'll see what I'm talking about, how much more activity there is in there, and there's nothing like liquidity. Now you look at the liquidity that we have here and you'll see thousands of options on each side trading. I'd rather be in there. So I'm going to do this in a Johnny way using a limited amount of money. Let's see how much delta I create, short delta I create, and we'll see if my hypothesis about volatility upticking may be signaling that the market is getting a little too frothy. So I'm going to look to do a $10 wide call spread by a $5 wide put spread. That should give me short delta. So I'm going to look at selling the 374. Why the 374? Because I'm trying to get a $10 wide spread that'll give me around a $3 credit so that as a standalone trade, this trade matches up. We like to collect around 1/3 the width of the strikes when we're doing a trade. $10 wide, you'd be looking somewhere around $3, which gives you about, we say 70-30 probability of success. That's a little bit more than $3. So my probability of success on this trade is going to be a little lower. But as a standalone trade, I would say this is a good trade. If you had a good setup, not a good trade. If you had a small downward bias and you wanted limited risk, you got about $670 in risk in this trade, and you wanted some short delta, you've got about 16 short delta, this would be a good standalone trade. Good probability of success, wrapped around 64%, gives you the short delta that you want, it gives you the $2.50 in theta decay, and beta weighted deltas are pretty similar in the Qs to SPY. They've gotten a lot more correlated or a lot more higher as the Qs have gotten higher. Now, for me, I like to sell premium, so I want to sell more premium than this and see if I could improve on or keep that same probability of success, let's take a look at what I'm looking to do. So I'm going to go to a $5 wide call spread. I'm sorry, $5 wide put spread, but I want this whole total to be over $5. Why? Because then I won't have any risk to one side. So I'm going to sell the 366 puts. I'm going to go $5 wide. So that means I'm going to go to the 361s. And here you'll see I actually did this trade at $5.02. I did it when the NASDAQ was only up around 55 or 60. You can see the NASDAQ continues to rally up almost $90. I did this spread at $5.02. You can do it better than me right now at $5.09, probably maybe $5.08, depending on when you listen to this podcast. Let's take a look at it. This green line shows you where you make money. Obviously, if you're collecting $5 in credit, your break even to the upside is going to be around $3.79, not at your short strike, but at your total credit plus the short strike. And obviously, your amount of buying power you're using has gone down by the credit on that put spread that you received. So you only have $5, $500 worth of risk, and your probability of success actually goes up. It goes up to around 66, 67, which is around 1/3 the width of strikes. To me, this is an intelligent way of getting some short delta. My deltas are only just under 8 now, so I've cut down my delta on my overall position, but I've increased my theta decay. Is this an omnidirectional trade? No, I don't think it's an omnidirectional trade, but let's take a look at how fast this will move if the Qs go $5 higher tomorrow. Let's see, what is your real risk on this trade? I know your conditional value of risk is obviously, the difference between the width of the strikes on where your risk is, and your risk is all to the upside because I want some short delta. But let's simulate without going to, the Analyze tab, which you certainly can on the Tasty Trade platform. Let me just show you a quick, easy way on how to do this. All you have to do is move all your strikes down by $5. Now let's see what I'm going to go here. I'm going to go to 356. I'm going to go down to the 361. That's a $5 wide put spread. Remember, the stock is going higher, so I'm moving my put spread away, which means I'm going to have to move my call spread closer. Again, I'm just simulating if the Qs go up in the next day, 2 or 3, $5, how much will I lose on my overall spread? Because making money is easy to spend the money, but losing money makes it a little bit harder than that. So $5 lower would bring us to 369, and then I'll go to 379. And you'll see that this spread is trading around 568, 570. So what's my real risk on a big $5 move in the next day, 2 or 3, even though there is a $15 expected move over the next 26 days? If we get a third of that move in the coming day, 2 or 3, this spread will be trading somewhere around 550 to 580. Let's just call it 570. My risk on this trade is around 55 or 60 cents on a big $5 move very quickly. So it gives me time to stay in this trade. Again, I'll just clear this for a moment, show you my trade one more time. I'm selling the 374 calls. I'm buying the 384 calls. I'm also selling the 366 puts, and I'm also buying the 361 puts. I did it for $5.02. You can do it right now at $5.09. And you know something else you can do right now? You can open, move, or transfer your account to Tasty Trade. Help us keep the lights on here, and you get to take advantage of some of the many promotions that they have there. Go to tastytrade.com, support us, keep the lights on.